Welcome back, everybody. Markets are way out of line with reality, at least according to this Wall Street Journal article. But the question I ask is, does it really matter? So in this video, we're going to break down the methods they're using to determine the market's current valuation, talk about what could be causing the differences over time, and explain what it means for us as investors. So let's go ahead and get started. Now, if we just start with the article in the Wall Street Journal, the title is Markets Are Way Out of Line with Reality According to These Measures. And what I liked about this article was that, it really talked about these different ways to say the market's overvalued or undervalued and tried to look at both sides in terms of, okay, we see what the numbers are, but what does it actually mean? And to me, that's super interesting. And he talks about that a little bit at the beginning when he says, the pushback I most often receive from readers is that true investors should ignore the day-to-day swings in the markets that obsess traders and just buy and hold stocks. Now, remember, we just talked about this in my previous video about how people want to put labels on things and, if you're a true investor, then you buy and hold, or you look at this and you don't look at that. And I told you guys that I don't really do labels. I don't like that. And I just think it's interesting to hear someone else kind of say that of just like, look, I get it, buying and holding, time in the market, all that stuff is important, but that doesn't mean we should just ignore other things and blindly hold for no reason. At least that's how I took it, because that's how I believe it. So he goes on to say, however, even the longest term thinkers should adjust their portfolios when prices are way out of line with reality. And he talks about the dot-com bubble or the COVID bust and all those type of things. Now, here's where I would say I slightly disagree. I think it really depends on how you're managing your portfolio, because for some people, buy and hold is really their preference because they don't want to get into trying to time things or trying to determine if something's undervalued or overvalued or even actively trade. They want to accumulate companies and they're okay with whatever that means over time. That's a perfectly viable way to do it. So I don't think you have to be getting in and out if something's overvalued, and we're going to talk about why here in a minute. And then he talks about the three gauges he's going to use to kind of walk through the market valuation. And one's the CAPE, the forward PE, and then the Fed model. And we'll touch on each one. And so the first one he shows here is Robert Shiller's CAPE model, which is basically the cyclically adjusted price to earnings measure. Try to say that 5 times fast. I can't. And what it shows is that currently we're at about a 35 adjusted PE ratio, which would be the third highest basically in history, only to what we were at in November of 2021, as well as where we were at right there at 2000 and 1999 around the tech bubble, which means that our current adjusted PE is higher than it was way back in 1929. Now, that is a pretty crazy statement to make, right? I mean, as we all know, 1929, Great Depression, all those things. And saying that our current price to earnings, or adjusted price to earnings ratio, adjusted for inflation, because that's what his measure does, is actually higher than every other time in history other than 2021 and then the tech bubble. Insane. And so kind of the first question here is, well, what does that actually mean? So what stood out to me about the 1929 number was just imagine if the next 10 years were similar to the 10 years after the 1929 crash. Because what you may not know was that from 1930 to 1940, the S&P 500 actually was negative over that 10-year period, with a total return of negative 10% or a little less than negative 1% a year. So just imagine how you would feel if over the next decade, your S&P 500 investment was actually negative 10% over 10 full years. I mean, imagine all the FinTwit accounts that would just be losing their mind with time in the market greater than timing the market. It would just be insane. But I think the real question is it likely to happen? And I know this is a spot where someone's going to say, well, people always think it's different this time, but it's not different this time, or some other investing platitude that we've all heard over the years. But one of the reasons why I struggle with putting so much stock into old data is because I feel that it lacks context. What's different now than in 1929? Well, a lot. Stock market participation is way higher now. It's not nearly as niche as it was back then, because only 10% of Americans owned stocks in 1929, while now it's slightly over 60%. Now, obviously, the impact of the 1929 crash wasn't just on people who owned stocks, it was on everyone, but still, the stock market wasn't looked at the way that it's looked at today. The money supply has gone up a lot and continues to go up. Index investing is more popular than ever, and in general, it's not very price sensitive, since many or most people are just DCAing into index funds with their paychecks every 2 weeks, no matter what. And along those lines, I saw this on Dividendology's Twitter last week, which I thought was interesting. The introduction and popularity of the 401k means there are a lot of dollars automatically being invested into the markets each paycheck. And the interesting part is when I looked at the difference in returns just to see how they stacked up, from 1900 to 1980, the S&P 500 average returns were a little over 9%, which is pretty good. But then since 1980, they are just under 12%, which may not seem like a big difference, but that's a 32% increase in growth rate, so definitely not insignificant. I don't know if that's because more people are investing, or because of 401ks, or because of passive indexing, or because of money printing, or some combination of all those things. But I will say it makes me question if comparing PE ratios in 2024 to PE ratios in 1929 makes any real sense or not. And now, I know that the Shiller Cape is inflation adjusted, but again, context of the market was different back then. So is it a meaningful comparison? I don't really know. And I'm not trying to say that a PE of 30 is good or that it should be normal. I'm just saying that context matters. Because if you looked at the PE ratio of a company like Google back in the first 10 years after their IPO, their PE ratios were much higher than the last 10 years. And obviously that's because the business was in a different part of its life cycle then. It was a high growth, lower earnings, and it slowly changed to a higher earnings, slower growth company. So expecting Google to go back to like a 50 PE that they had in 2007 would almost be nonsensical for an investor. So why do we think that a PE ratio in 2024 compared to one in 1929 is meaningful? I don't really know. So I would love to hear what y'all think about that though in the comments, so let me know down below. Now, next, they talk about the Fed yield model, which I'm not really going to touch on this, but I did like the commentary that was down in the article. And so I'm just going to read this here. So far, so simple. Sell. Unfortunately, long-term investing isn't this easy. Each of the measures has pros and cons, and the cons have in the past led to some terrible investment decisions. The Cape reached its highest since 1929 in July 1997, when the gauge passed its roaring 20s peak shortly after Federal Reserve Chairman Alan Greenspan warned of irrational exuberance in the market. Exuberance there was, yet an investor who bought when Greenspan spoke had made an annualized return of 7% a year above inflation since. Worse still, the Cape has been cheaper than its long-run average only once since then. True, this buy signal in March 2009 worked brilliantly, but investors using the measure are unlikely to have held as the S&P soared straight back to being supposedly overvalued. And then it continues, for Cape to get back to its long-run average, there would have to be the mother of all crashes. A more likely explanation for Cape's levels, stocks have moved to higher valuations over the past century as mutual funds and ETFs made it easier and cheaper to buy equities. Wealth increased, and since 1980, after inflation interest rates tumbled. And so exactly the things we were talking about earlier of just, does it really make sense and is it a meaningful comparison? I just don't know. And then later on, they share this third chart showing the expected returns over the next 10 years based on the forward PE ratio, which in general, I think this would have been an interesting concept, except it's a relatively small sample size between 1988 and 2014. And obviously, it's going to be skewed by the year 2000 tech bubble, so it's hard to know what to take from that, especially when it stops at 2014. And since then, we've had some of the best years in the market in a while. So, okay, that was a lot of information, but I think the real question is, what does this actually mean for us? Now, believe it or not, the more I see this type of information, the less I believe that historical ratios are meaningful past a certain point. Like maybe if we took ratios from 1980 on, but I just don't understand what value a 100-year-old price ratio has to tell me, but that's just me. I do think the danger with this type of information is you could have people that overreact and sell out of a market because it looks, quote, overvalued and potentially miss out on really great returns. I mean, we saw that even just here over the past 2 weeks where everything looked really grim in early August, and now we're basically back to where we were just a week or two later. So for me, I think this really reinforces the idea that if you're long-term investing, there's really two approaches that make the most sense. There's just blindly putting money into the market each week, whether that's in one index fund or a few index funds based on some predetermined allocation. And we've talked about that a lot on this channel, how that works for just about everyone. But then there's actually picking stocks where you're doing the research on the companies and really trying to understand them. I feel like anything in between probably makes less sense, just for the simple fact of DCing into an index or a few indices every single paycheck ignores everything else. It ignores valuation, it ignores historical comparisons, so it doesn't actually need context. Because what you're saying is, I don't care about context, I'm just constantly investing, and I'm going to take what the market gives me, and over time, I think I'm going to do well. And history's proven you right. And it helps that you have those tailwinds that we talked about before of more people than ever are investing, more 401ks are automatically putting money into the market, passive index investing keeps increasing in popularity, the money supply keeps increasing and accelerating over historical averages, and all those things point to more people buying equities in a less price-sensitive way than maybe they did in the past. And that's partially why it works, because you're saying, I'm ignoring any of this context, I don't care, I'm just going to constantly invest. Whereas if you're buying individual stocks and doing all the research, then you're actively looking for the context for each company so that you can determine what reality is on a stock-by-stock basis. For example, is McDonald's really undervalued right now, or is it just that their historical price metrics are skewed because of a lower interest rate environment over the past decade? As an investor, you can dig into that in detail and make a decision on it. Now, obviously, I'm biased because those are the two approaches that I've taken basically my whole life to invest, but I do truly believe that you need to probably be in one camp or the other to where you're completely ignoring the context and just investing, or you're getting deep into the context for each individual company so that you know what reality is. Trying to navigate all this in between with the market being overvalued or undervalued based on whatever measure you use, I think is just too dangerous to do outside of those two different approaches. Because you risk overreacting to data that may not be meaningful in our current market context and missing a good part of potential market gains because you're chasing old ghosts. But that's just me. Now, I would love to hear what you guys think about this data or if you think these 100-year-old price metrics are meaningful or not. So let me know down in the comments below. Now, if you missed my video about how I sold Caterpillar recently and you want to check that out, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.